Hi, I'm Jeff Hibbeler, Senior Portfolio Manager with Exencial Wealth Advisors, and today I'm bringing you an economic and market update following the March employment report. Coming into this morning's payrolls report, expectations were relatively high, expecting a give back from the winter storm effects in February and a strong ADP employment report that was released this Wednesday. However, payroll growth far exceeded consensus expectations and was near the top of economists' wide range of estimates. The headline non-farm payroll number grew at over 900,000 jobs in March, compared to 660,000 estimates. Private payrolls, which exclude government, grew 780,000 versus the 643,000 job estimate. Nearly all sectors posted growth, and with private services and leisure and hospitality leading the way. Goods producing and construction sectors also grew at a strong pace after they had posted losses in February, likely due to weather effects. Government payroll job growth of 136,000 was nearly all in state and local governments, and no doubt benefited from more schools returning to in-person learning. The 2-month net revisions that were released were over 150,000, so on net this report added over 1 million jobs to the economy. Looking at the unemployment rate, it dropped to 6% from 6.2% and was in line with estimates. Household employment grew also strongly at over 600,000, and labor force grew roughly 350,000. Now, this data is compiled from a different survey than that for non-farm payrolls, and the two can vary from month to month, but over time they tend to coalesce. Labor force growth increased the labor force participation rate 1/10 to 61.5%. Now, this is running about 1.5% to 2% below pre-pandemic levels, and it's important to push this higher as that will bring more workers back into the labor force, and that will benefit our long-term economic prosperity. For the Fed's goal of maintaining maximum employment, increasing the labor force participation rate will be one of the indicators that they are focused on. Finally, the broader-based underemployment rate dropped to 10.7%. Looking at average hourly earnings, they did decline from the prior month and came in a little bit below estimates at showing 4.2% year-over-year growth. That's likely due to the large numbers of service and hospitality workers, growth in their sectors, and those jobs tend to be on the lower end of the wage scale, and those sectors were affected disproportionately by pandemic shutdowns. Average weekly hours rebounded to 34.9 hours per week, and that's back near the historic highs for that data series. A higher average tends to foreshadow future job growth as businesses first increase hours for their employees before they add to staff as their demand increases. The market reaction was muted across most markets as many are closed for Good Friday. However, the Treasury market is open for a half day today, and the 10-year benchmark is currently trading off a few basis points and was around 1.7% in light trading volume. On behalf of my fixed income colleagues, thank you BLS and thank you SIFMA.